Okay, cool. All right. Beth Ricklefs here with IAMS. Let me fix my hair here real quick. I am a life insurance sales director here at IAMS. I'm super excited to talk to you today about the building blocks of life insurance. I think if you understand the way I understand life insurance, this is going to make understanding case design and things that you're asking for when we're dealing with term insurance, permanent insurance, and all of that. Um, some of this might be a little overwhelming when I share it. Don't freak out about that. There are going to be pieces that you'll definitely gravitate towards and pick up on those pieces. And then it's something ongoing that we can build on with the knowledge of the backbone of how life insurance products work. So we are an independent marketing organization. We With our new producers, we do offer a new producer bonus for your life and annuity production. So here on the slide, I hope you can all see my slides and my webcam, but here on the slides, you can see that for every 100,000 of FIA business with IAMS, there in the first 180 days, you're going to earn certain production prizes. That could be a postcard mailer, an iPad, cash. How that equates to life insurance is it would be 10,000 of target premium or 100,000 of single premium life. You can build on top of that. So we've got our 250 level all the way up to $1 million. So if you are newly contracted with IAMS, you really want to make a goal to start hitting those levels. It's the best way for you to experience all the different services that we offer here at IAMS, and a great way to build up marketing dollars and all of those things as well. IAMS Business Builder, we do offer a referral producer program. Our business is a lot like yours, and that the best people that we have to work with are usually referred to you in the field, somebody that you respect and like in the business, a colleague, etc. And if they get contracted, we do offer a $50 one-time bonus. We do pay that out every quarter. And then we offer commissions on top of that. So for every thousands of dollars that for all the business that they write, you're going to get a commission trail off of what they're writing at different levels with target life, single premium life, index annuity, and MIGA. That is not a haircut off the top street level commissions that the agent will get with IAMS. It is out of our pocket as a thank you for supporting our business and referring a great agent to us. So that is one way to have just an extra thank you from us. It's a great way to build up money that you can use for marketing dollars, among other things. And then we do offer marketing reimbursement for every 10,000 of target premium. That's going to earn you $200 of marketing dollars. For FIA, every 100,000 of premium is 100 marketing dollars. And then for every 100,000 of single premium life, that would also earn you $200 in marketing reimbursement. And I love to spend money, so here in a little bit, I will show you how you can use those marketing dollars. We offer back office support, which I've been in the IMO world for a long time. Everybody says that they do the back office support. We do it better than anybody else I've ever worked with, from the sales directors that you're going to get to work with on the life and annuity side to building out cases, strategic planning and products that you're working with. If we need to do some pre-screening on underwriting, especially on the life side, to make sure it is a good fit with the right carrier. To help you position that appointment and how to present it. We are going to have forms at your fingertips which has to do with our IAMS website. If you haven't registered at our website, that's IAMSinc.com. Very easy process to get signed up for that, and you'll have underwriting guidelines, any kind of form that you can think of. And then we manage that case from the very beginning stages of the case when it's a prospect to you, and we're working out what you've done in fact finding to figure out what are the right products to fix the problems that they might have, to getting that case submitted. On both the annuity side and the life insurance side, we have the most amazing case management team that follows that business from the submission of the application all the way through the underwriting process to getting a approval, helping you get that delivered, and then getting paid as well. And then even after the fact, there are things that you have to worry about, like service work, such as change of beneficiaries, getting enforced illustrations, all of those types of things we can help out with as well. We have the best life and annuity quote engines out there on our website, and with the experience level that we have with all of our directors, you're going to be talking with top sales experts that we talk with so many agents all across the world, well, all across the United States anyway, which gives us an advantage to share feedback, what's happening in the industry, how other agents are positioning cases, so that we can help you with that as well. Paperless contracting, we do use Sure LC, which is a great system, especially with all the just-in-time teams that we can present products that you may not be contracted with at the moment, but easily make that a smooth process to get you licensed, so that you're ready to write the case with that particular carrier. Like I mentioned, you want to go to IAMSinc.com. You're going to have excellent sales tools. One of my favorite things on there is the sales resource library. All right, sweet. Thank you. All right, so you're going to want to I'll just back up just so you didn't see those slides. We got the new producer builder bonus. That's what I was talking about. The IAMS builder, business builder with the referral bonus and the marketing reimbursement. We talked about the back office support and the IAMS website. You're going to be able to quote term, GUL, annuities. One of my favorite things ever is the sales resource library. If you haven't spent some time on there, you're going to find some awesome presentations, some great calculators on there, articles, just prospecting information. So do pay attention to that. Industry links. We keep you current on the life and annuity news. You're also going to be able to get to our YouTube channel, or if you've been in the training, you'll be able to see upcoming webinars that you might want to get signed up for if you're not getting an email to encourage you to sign up for webinars like this. EAP solutions, most of our business is submitted in some kind of electronic version. Luma is the annuity platform. You're going to be able to get everything on there. I do believe you have to register for Luma once you get onto the IAMS website, but you're going to be able to quote annuities, see the process from submission all the way until it is delivered. You'll be able to see the policies going forward too. So it's a great tool for managing existing clients as well. Firelight was our original platform for annuities. Firelight and Luma work together. We do have the straight Firelight still because there are a few life insurance carriers like F&G, Allianz, National Western Life that use Firelight. iPipeline is where the majority of our e-applications happen for life insurance. You don't have to register for iPipeline. As soon as you're registered on our website, you are registered to use our iPipeline platform. And Sunfire is where most of the submissions for our Medicare business. Again, you have that access through our website. So if you're working on the weekend and the evening, all of those things, you can do all of these electronic platforms. There are a few carriers that still take paper applications, so don't hesitate to call and ask if we can do it that way. If you really need to, we certainly can help out there. Our creative services, this is where the marketing dollars come in, where you can spend. We have the best creative team for marketing. Really, you are limited only by your imagination with what our creative services can do. Here are some of the most logical things like logo design, business card stationery, handout brochures, helping you design your website, social media, and again, just anything that you can think of, our creative services can do for you. Our marketing dollars can help with any of the costs for that with creative services, and the dollar goes a little bit farther than paying it outright with our prices on creative services. So if you're earning marketing dollars, that's definitely the way to go with our creative services. We offer, in conjunction with working the marketers, the annuity and life insurance marketers, we work very closely with the creative services, and we do offer a complimentary marketing analysis. So if you are an existing agent, new to IAMS, whoever, if you have not done a complimentary marketing analysis, you definitely want to schedule time with your director. It can be your life director, your annuity director. We can get on the call together and go through that marketing analysis. Once we have filled out the information, we send it to our creative services team. They look at where you are with marketing. You could have something in place already. Maybe you have nothing in place at all. It doesn't matter where you're starting. We can help you build out a marketing campaign and build that. Where you want to go, what's your target market that you're trying to to focus in on, all of those things, and then we can come up with a designed plan just for you. A lot of the other IMOs that I have worked at, the way they do things is they do like a cookie cutter type of plan that might work for a good majority of agents, but it doesn't take into consideration your demographic, what you're passionate about, and all of those things are what we're looking at when we design the complementary marketing plan and what elements you should be implementing in your business to reach your production goals that you create for yourself. IAMS Wealth Management is just a full package. Everyone knows that if you add a line of service to your business, you retain more clients, you get more sticky with the people that you're working with. It makes you not just a transactional agent, but a lifetime agent for them to meet multiple needs. So if you're only a life producer, adding in annuities or single premium disability, that helps your retention. Annuities, adding life, long-term care disability, that can help your retention. But adding wealth management is just another piece of that puzzle that really gets people dialed in to retaining them, getting more referral business from them. IAMS Wealth Management can meet you wherever you are in managing wealth. You could have never, ever done it before in your life, and it's something that you want to look into. We have programs to help you with that, all the way down to how do you get ready for the tests, the series tests that you need to manage money. If you are already doing wealth management or experienced wealth management, there are definitely awesome reasons why you want to be doing the business with IAMS Wealth Management. I can get you in contact with any of them, but if that is of interest, please reach out to us because it is a great way to improve client retention. It's also a way to get a steady income stream into your business because they do pay monthly fees. We offer life and annuity academies every year. Obviously, we're at the end of the year right now, so we're not going to do any more for 2024. We will start announcing dates at the beginning of next year. Usually we start off in the spring. First of all, it's a great way to rub elbows with other agents that are all over the country to get ideas that is working in their business. You're going to hear advanced sales ideas, in-depth investigation into different marketing strategies, look into micro tax planning, building your brand, more talk about IAMS wealth management, but you will not waste your time by being at that 2.5-day seminar. It is a great way to retool, get some new information to implement in your business so that you're meeting the goals that you want to establish. Our trek to Quebec, we are a little bit different with other IMOs in that our trip is an 18-month qualifier. It's been in effect almost for a year now. So January 1st of this year is when the qualification started. You still have qualification until June of this year. There's still plenty of time to meet this trip. And if that is something that you're wanting to do, the best way to do it is talk to your life director, talk to your annuity director. What products are you selling? And then in conjunction with that marketing analysis, we can come up with a plan on something that you need to be doing on a monthly basis to join us in Quebec. It's going to be a great time. That's in August of 2025. Make sure that you are following us and liking us on LinkedIn and Facebook. And with that, I will get started on my presentation. All right. I got to find the other PowerPoint. I started in the business. Coming up this January. It will be 24 years, but I grew up in the life insurance business. I'm the fourth generation of life insurance professionals in my family. And one of the mentors I had when I started with another IMO, they were brand new to bringing on life insurance as part of their marketing plan. And I was a part of that team to build it. I had a great group of mentors in that organization. And one thing that inspired me was a man that broke down everything about life insurance. And it's what I still live off today when I'm looking at new products, analyzing products for you and how they work and why it's a good fit. And that was, and this sentence may not make a lot of sense, but what he taught me was that all life insurance is term insurance. Some of it is pre-funded and some of it is not. Now, when you hear that statement, some of you might disagree with me right off the bat, but I'll explain why thinking about it that way helps you understand any product that you're going to work with, whether it's level term, annual renewable term, if you're dealing with any of the UL variations, whether that's variable, index, universal life, whole life, all of it fits under this category, and I will show you how that works. I am going to be, I did this presentation for some other agents, and I tried to do it on a whiteboard. I'm going to try to do a combination of things so that I don't lose any of you. This is just a graph here of if we start at age 0, and we go all the way to age 100. So 0 to 100, here's, this line is age. And then cost of insurance, which is going to rise every year that we live. And in this example, we're going to talk about $100,000 death benefit, but it could be $1 million death benefit, doesn't matter. That top line is just what we consider the death benefit. So this line here is the cost of insurance. Every year that you live, the likelihood that you're going to die increases. And then if you add in health factors and things like that, obviously your mortality increases. If you are looking at that, I made it a straight line because I am challenged when it comes to doing PowerPoints. I actually had my kids help me with this last night because, they're good at that stuff. So if we're looking at it like this, instead of a real straight line like that one is showing on there, it's actually more like a stair step, something like that. It goes all the way up until we hit age 100 here. So that is also very like the very first product that came on the market, which is annual renewable term. So when people started selling life insurance, they bought it every year on an annual basis. So they bought it for 1 year at a time. The insurance agent would come out and say, hey, you want $100,000 of life insurance? Yes, I do. You are 45 years old for this year. It is going to cost this much money. And then the next year would roll around. You're now 46. Do you still want the death benefit of $100,000? Yes, I do. Well, now because you're a year older, it's going to stair step up. It's going to be a little bit more expensive. So that is the backbone of every single life insurance policy that you will ever talk about. And then we came up with level term. Most people didn't just need life insurance for a window of time of a year. It was usually to manage some kind of financial hardship that would happen to a family, a business partner, something like that. And they're like, hey, can we buy this for a larger window of time? And what they came up with is level term. So here is just an example of if we have a 20-year term, that it's just this window of opportunity right here that we have the life insurance. Now, internally, that cost of insurance is going up into the policy, but they don't charge you that every year, right? So what the insurance company does is they add up all the costs that are in that 20-year period of the annual renewable backbone, add them together, divide them by 20, and then they also know that they have the time and use of your money. And so instead of this line continue to go up, what they do is they bring that line down, they suppress it down here. So that's your level term. So that diagonal line that you see, what they did in that 20 years, they brought it down kind of just like a spring or a wire that you would push it down to that level mark, and that is what they are charging for premium. So when you have a level term like this, you get to keep it level for 20 years. And the 21st year, you get to keep it. I need to go back. And the 21st year, you get to keep it. You get to go to annual renewable rates. But then the pressure on that spring is no longer suppressed. They let it go, and it pops up to that 21st year. And then you're going to be back at annual renewable rates unless you do something different with it, like convert it if it's possible for conversion. If you're still healthy enough, you might qualify for a new term and suppress that wire back down. Those are some of the options. Or you might be so unhealthy that you really, really need the life insurance, and so you will put up with these annual renewable rates because you need to have it. Then you have permanent insurance. When I talk about permanent insurance right now, what I'm talking about is all permanent products. So whole life, universal life, variable universal life, index universal life, regular old traditional universal life. When somebody said, the first one on the market was obviously whole life. We came up with whole life, and, people are saying, oh, well, the 20 years, that's nice that you leveled that out for us. But we can see where we're going to need life insurance forever. So what is the best way for me to manage life insurance so that I make sure that I have it for my whole life? And that is where whole life insurance came into being. So what you have is from 0 to 20. The cost of insurance is going up. But here at the younger ages, you can see your cost of insurance is really low. So the insurance company says, hey, for the dollar that you're paying for insurance, let's say it's $1, 25 cents of that is going to go and cover costs. And the other 75 in this example is going to go into some kind of cash accumulation that's going to help us offset the annual renewable cost into the life insurance. So you put those into the general account with the life insurance policy, maybe with the whole life, with the universal life, also a general account that gives a fixed rate. Index account, still in the general account, but you get the option of determining different indices that determine the rate of return that you're going to get into the life insurance policy. Then you have variable aspect where it's no longer in the general account. It's actually subcategories and the market that you own. But the idea behind the permanent plan is that, yes, we've got an annual renewable rate that is occurring in the policy, but we're going to offset it for cash value. So in the later years, we lower the net amount at risk and the cost of insurance on the policy. So as you see, this is just squiggling here. When you get to age 50, I just did this as kind of a halfway mark, although life insurance, all permanent life insurance is front loaded. So in the beginning years, you do have higher costs that are happening, like paying your commissions, brick and mortar, underwriting, all of those things that are front loaded into the contract. So it's not exactly in a 0 to 100 at age 50 that you'd have 50% of your cash value. But in the later years, if you keep funding it, it will have a turnover and you'll see a good spike and the cash value of the life insurance. So here at age 0, or right here at age 0, your net amount at risk is the full 100,000. So you're paying the full cost of insurance for no insurance at all the way up to this 100,000. The insurance company is fully at risk at age 0 or at point 0. If we look at age 50 or 50 years into the contract, you've built up this cash value, and we've got this much cash value in this bottom triangle, and now we've lowered the cost of insurance to you, because instead of $100,000 net that is at risk to the insurance company, now at the 50 mark, let's assume we've got $50,000 of cash. Now the insurance company is only at risk for $50,000 of the death benefit. So although your cost of insurance is rising every year with the annual renewable rate, you are paying the annual renewable rate now internally of the product at $50,000 instead of a full 100, which would be very expensive 50 years down the road. And then the goal is that between now from point A or 0 age all the way to age 100, that we've built this cash value up so that at age 100 we endow. So what we want is that the insurance that we've built up enough cash value that basically you're the winner of the contract, you beat the odds. We don't have to use the net amount at risk for the life insurance to make up that $100,000 due to your good, persistency with your life insurance contract. We've got at least $100,000 of cash for $100,000 of death benefit. I use 0 to 100, but as you may know, that there are actuarial tables now that go to 120. So you may see some contracts that instead of endowing at 100, like they did when I was in the business 24 years ago, you might see their projection as a later date of like 120. But just for simple explanation, the goal is that it endows at some point with your cash value life insurance. The difference between using a whole life contract versus a universal life contract is that everyone talks about sorry, I'm trying to manage my time here. Everybody talks about whole life having these wonderful guarantees, which is absolutely true. They have great guarantees. Whole life is basing your premium based on the worst case scenario. So based on the worst case scenario, the highest charges that they can charge in the contract, the lowest interest rate that they possibly can guarantee, no dividends, that kind of thing, based on that worst case scenario, that it will still endow at age 100. Universal Life says, hey, we aren't going to collect the very most premium that you do to meet the guarantees. If you want to assume like a 5.5 interest rate based on that and current cost of insurance, you could actually put this premium in, which is less, and it's still going to endow at age 100. The way I think about it in my mind is there's two people when it comes to taxes. There's those that like to overpay their taxes in their 12 months so that in April they get a return of their premium. And there's some people like myself that like to pay the IRS what I really think what I owe for the 12 months. And in April, if I'm at a zero balance, then that's a winner for me. So that's, to me, the difference between a UL chassis and a whole life chassis. Whole life is saying at the end of the year, if they collected too much premium, which they often do, then they give that back to you in the form of a dividend. All that dividend is a return of your premium. And then you get to decide things like, how am I going to use that return? Most people put it into buying more paid up insurance, which is going to increase the cash value of the life insurance beyond the guarantee. It's going to help purchase more life insurance. You might use it to reduce premiums in the future. You could take it on deposit, which is the worst option that you have with a dividend. You could offset loans. There's a lot of different things. Most people try to do it with paid up additions. That's what's going to get the higher cash value in the whole life and an increase in the death benefit there. With universal life, like I said, you aren't paying that extra, so you aren't getting a return of your premium. That's why the dividend is income tax free when it comes back to you, because they're just returning your premium. The reason I say that putting it on deposit is the worst, it's basically putting in a glorified savings account, and then you get a 1099 on it every year, which that's what we're trying to avoid when we use cash value life insurance. So anyway, endowment, winner, winner, chicken dinner. We beat the odds. We built up the cash value and the life insurance. And that is the backbone of how every permanent product works. Now, we will go in some discrepancies of like why the cash value is so important, especially in the later years, to lower this, this net amount of risk that we're trying to lower. We're trying to make it itty bitty in the 90s, make that net amount of risk to the company so low so that our cost of insurance is getting lower instead of higher. So we'll go on to the next slide. So here's an example of like maybe a universal life where we didn't quite do it so that it endowed to 100. Now the death benefit could still stay in force, and it could still, it might, most likely could still pay out, but you're raising the cost of insurance or the net amount at risk. So unless you've got enough cash value in that situation, so unless you have enough cash value in that situation, so let's say we move the cash value down to here, this ART rate is still going up, and now every year the net amount at risk is getting higher well, it's not getting higher, it's staying the same, but you're getting older, so that cost of insurance is getting higher. So if we don't have enough cash value in there, maybe not to endow it, but enough to offset what that cost of insurance is, so it's not dipping back into the cash value account to pay to offset the cost of insurance, then we could get in trouble where a policy might lapse or not last as long as we wanted it to. So here's an example of a cash value where we would maybe get in trouble. So I'll show you a couple demonstrations of what level term looks like, ART looks like, what does a whole life look like, what does an endowed UL look like, and I'm also going to show you a UL where we have a declining cash value. And what's happening is that your net amount at risk is either staying the same and your cost of insurance is getting higher because you're getting older, or it's dwindling in cash value, causing a double whammy, cost of insurance going higher and our net amount at risk is getting higher. And those are the policies when you get statements from prospects or even clients that have been in your books. I'm sure that most of us have heard the horror stories of like the 90s of underfunded UL. It still haunts us to this day. I still review life insurance policies that are underfunded and get into this scenario mainly because of not good policy reviews and such. But once it goes south, once it starts to hit this dive, unless you add more premium or do something about it I call it stop the bleeding, you have the potential of losing that death benefit altogether. And that could be a big problem. And if you're taking out loans, like we do not want it to lapse because the loans are based off a leverage of the death benefit that will eventually pay out. And if we lapse that policy, there's going to be a big taxable problem to the owner of the contract. So I'll show you some examples of that as well. So let's get into that. I didn't pick these companies for any loyalty reasons or whatever. It was just the easiest way for me to explain how they work. There aren't very many annual renewable rate terms out there. There are a few. Equitable has a good one, but their minimum face amount is $1 million. So that's what I had to go with. So if we look at Equitable's annual renewable term, you can see that it starts out at a 45-year-old. The annual premium is going to start out at that $948 for that 1 year for $1 million. And then the next year, if we want to keep it, it's going to increase, and it's going to do exactly like I said with that line going up, that the cost of insurance goes up. So let's just assume that they kept this for 20 years. You can see right here that the cumulative premium is $81,643. $81,643 divided over a 20-year period would mean that you were actually paying about $4,082 a year for that contract. Equitable, I would have used them too, but they didn't have a good illustration to show what happens in the 21st year of a level term. So I used Transamerica for that. So here, if we just bought a level term, then the rate starts out higher. We were starting out at $940 with an annual renewable rate. It'll be a lower cost for a level period of 20 years. And you can see it, well, I don't know their math exactly, but if you added up the $1,440 times 20 years, that's $28,800. So it's less than the outlay of the $81,000 in the contract. And that's because in the early years, they are collecting more of your premium than is necessary for the actual cost of insurance. They have the time and use of your money and so forth. And just like I said, that just made that spring that we were like this, it made it level like this for 20 years. But in that 21st year, this the weight down on that spring, it is released and it goes up a lot. So it goes from your 1,440, it goes all the way up to $16,200 in that 21st year. This is why people are encouraged to make sure they bought the right level term for their needs. Term is great. I love term, but you want to make sure that it is meeting the person's need. It could be affordability, and they do need the term insurance. I first and foremost want to make sure people have the right amount of life insurance, because a beneficiary doesn't care if it was whole life, universal life, any of that. They just care that there is a death benefit to take care of them financially if something happens tomorrow. It doesn't really matter what contract it is, but longevity it does as far as planning. So it could be affordability that they needed to do the term. It could be that it was a specific amount of time that they actually needed that coverage. That could be raising kids, getting them through college, mortgage that you're going to have paid off. Your need for a big amount of life insurance should hopefully reduce over time, so that when we get into retirement age, you still need life insurance because there's always a cost of dying, but you don't have the big financial obligation that you do to kids, children, business partners, and those types of things, because you're doing other things to make up for that shortfall. But term is a very valid tool to use in life insurance. It's just that if you miscalculate and you needed 25 or 30 years, it could have been best managed maybe in a permanent plan, a longer term, making sure that there's great conversion options that you can move it to permanent. Because when you get to an annual renewable rate, what the life insurance carrier is saying, if you really, really need it and you're willing to pay that insurance, you're probably pretty unhealthy. So we're justified in charging that premium. Because if you were healthy, you just go get re-underwrited, and we would suppress that cost of insurance back down again. It would be at a higher level because you're older, but we would suppress it back down. But you probably can't qualify, otherwise you wouldn't pay that annual renewable rate. So that's going to continue to go up. And then it goes up by a lot, every year, maybe just by a little bit in the first couple of years, but then you're going to see it steamroll and get really expensive. And this is where we see people pay a lot more for insurance than they'd ever get back in death benefit when they go to annual renewable rate. Going back to that equitable one with the annual renewable rate, that's the 20 years. Sorry, guys. And that 21st year, it didn't go up as much as the level term did, but it's also going to get there where your cumulative premiums, here's the cumulative premiums. By age 85, you've paid more in premium than you're ever going to get back in death benefit. So let's take a look at whole life real quick. I use Mass Mutual. Again, it's not a popularity contest. I don't like them better than anybody else, but it was a good way to give you guys an example. So this is a whole life to 100, meaning that we're going to pay out 100, similar to what my graph was showing. And here, I used a 45-year-old like I did with the term. In 20 years, so on this side here, or here on the left side, we're showing the guaranteed assumptions that the whole life carrier has to choose. So in year 20, we have about $30,000 of cash. That would mean the net amount of risk to the company at this point is $70,000. Obviously, your cost of insurance has gone up every year, but instead of paying a pure 100,000 for the total net amount at risk to the company, the risk to the company, now we've lowered it down to 70. And then if we get to, let's say, age 80, now we've got 60,000 of cash built up based on the worst case scenario, paying that premium of $1,800. So we've lowered the net amount at risk now down to a $40,000 that the insurance company is at risk. And then just like I said, when we get to 100, winner, winner, chicken dinner, we won. We have matched the cash value with the death benefit it endows at that point. You can see on the worst case scenario at that point, cost of insurance stops. And then our cash value is 100, death benefit is 100 for the rest of, to age 121. Now, like I said, they're charging you probably too much. Mass Mutual is, historically going to pay a dividend, right? They're going to. So you're going to get a refund on that money, return of your premium, and you're likely going to put it in paid up additions. And then, so here, this is the non-guaranteed, here on the right side, is going to be your non-guaranteed assumption. So every time you get a return of your premium, you're able to pick up a little piece of a paid up addition, paid up policy that is also going to grow cash value, also earn dividends, etc. And that's where you see on the non-guaranteed side, it just steamrolled for the whole life carrier. So when we're looking at that 20-year mark, instead of having the $30,000 of cash, we actually have, where's the cash? We have 43, and because it's buying paid up additions and it might be coming up against corridor 2, well, actually just the paid up additions, it looks like. Now the death benefit has increased to $127,000. So you're going to see on the non-guaranteed side, because it can't guarantee the dividend, that this policy is going to grow really nicely. When we compare that to a universal life policy, I use North American. Now you can see the premium on here is a lot lower. It's about $600 lower at least. Again, they're not basing it on the guarantees. They're basing it, because their guarantee is really kind of bogus. So is the whole life, because it's based on the worst cost of insurance, and that there's little to no earning in the policy, which is never going to happen. Out of the 3 assumptions here, guaranteed, and this is your midpoint, and the non-guaranteed, the one that is the most inaccurate is always your guaranteed side. I don't care if you're talking about whole life, universal life, whatever. Unless we're talking about a no lapse guaranteed UL, the guaranteed assumption is the most inaccurate, because we know that we're not starting out with the highest cost of insurance. I backed this down to 5.5 interest rate, because a traditional UL should usually do somewhere between 4 and 5.5%. Hopefully in an IUL we'd actually be doing better than this. So again, just like taxes, this type of person wants to pay less, would rather pay right on the money of what they want to accomplish with the policy, where a whole life person wants the guarantee, and then if they have over projected, they want a tax refund or a return of their premium. A person that does buy a UL, they do need to have a good connection with you as an agent and an understanding, so that you're monitoring this and making sure that we're not getting in a bad situation where we're not collecting enough premium based on the interest rate or cost of insurance. But here at 20 years, I actually think this is at a lower cash value to it. And I'm not talking about overfunding IUL. That's a whole different story and subject. And same with the whole life. This is just to get it to endow. So we got 20,000. Again, it's lower because our front loaded costs are in the first at least 10 years of a policy, could be longer with paying commissions, underwriting, and all that kind of good stuff. And then you're going to slowly see it build. Death benefit isn't going to increase like that whole life did because it's buying paid up additions with that extra $600. If we actually put the extra $600 in this would be a different thing. But the whole goal was just to get it to endow. And so at age 100, I got it pretty close. We got 108,000 of cash. The death benefit is increased at to 108,000, pretty close to endowment. Cost of insurance shuts off at that point. I always get somebody ask me, why at age 100 do we start to see it keep building? It's because most of the charges of the contract are gone at that point, and so that you'll see it build. Then I wanted to give you an example of if we lower a death benefit. I'm sorry, let's see. Lower. This is a lower premium, and this is what I was talking about if we're not funding a cash value life insurance policy correctly, or perhaps we have suppressed or maybe we've taken loans out of a policy that aren't keeping up. It's starting to eat away at the cash value, whatever the case may be, but we're going to start to turn south. So instead of having a consistent cash value rise, once we turn the corner, we're in bad shape. So in this policy, you can say it builds until age 85 here. And then based off this lower premium of $1,000 a year, I lowballed it, obviously, just to give you an idea. Then we start to see the cash value go south. When it does that, when you see an enforce, like a statement from somebody, and you see from 2023 to 2024, the cash value has started to dip, that's something that you need to bring it to my attention so I can like rip it apart and figure out what's going on. But most likely they either need to start putting more premium dollars into it, or they need to stop the bleeding and figure out a different solution at that point, because now they're running the risk that they might outlive this policy. So in this one, just like I said, if we don't change the atmosphere of the $1,000 premium, it's going to start taking premium dollars out of that cash value to cover the cost of insurance, which is going to make things worse for us because it's going to increase that net amount at risk, and we're getting older and the cost of insurance is getting higher. So we got a double whammy, higher net amount at risk to the company and higher cost of insurance. And this one just expires at age 93. That's what happens. And just so I make sure to cover all my bases, of course, you could overfund a life insurance policy. So this was the most premium I could get in there based on a level death benefit of $100,000. That really helps us out if we can overfund in an IUL situation, because a small amount is going to the cost of insurance, and then we're building that cash value way quicker. So we're lowering that net amount at risk. And as we lower that amount at risk, we're lowering the cost of insurance even at younger ages, that is going to impact the cash value of the life insurance, so we can do really fun things with it, like take loans, withdrawals for tax-free retirement. You can do this with whole life too. I really have a passion for both. I love both of the contracts. So there's reasons we go one way or the other. So that would be overfunding the IUL, and it's basically to offset that cost of insurance and net amount at risk so that we can have access to cash value in the life insurance policy. Again, it's taking the lien against the death benefit, so the cash value is still participating, we hope, in whatever indice that you have, so it's still getting, and then a low rate of interest on the loan, so we have a positive arbitrage. And then why you see the death benefit increasing here is because we're hitting corridor laws that are established. That means that there has to be always some kind of net amount at risk for life insurance to be considered life insurance. And if the cash value has gotten too large to maintain it as that net amount at risk, then the company will start to increase that death benefit. And then you'll see in this situation, we're not even close to endowing. At age 100, because of the overfunding, no loans or withdrawals taken out of it, we've built up over $600,000 of cash. Cost of insurance stops, and then you're just going to continue to see that grow. So that's just the building blocks. What I want you to remember is if you think about that internal skeleton mechanism that's happening in all life insurance policy is that annual renewable rate. And what are we doing to manipulate it so that the cost of insurance comes down and the net amount at risk comes down? When you start to understand that, and like I said from the beginning, I don't expect you to understand this how I understand it, but hopefully there was a couple of things that you can gravitate to. We'll talk more about it, and then more of the things will come together, or we'll analyze more illustrations, and you'll be like, oh, that's exactly what Beth was talking about. I did not even address an increasing death benefit. That's a whole different drawing. And obviously you can see I don't do a very good job of drawing, but there's a whole different reason why we do that, to get more premium dollars in there. That is, obviously well utilized and so forth. If you have any questions, let me know. I think that I covered everything. I don't know if I didn't look, I can't talk and present and answer questions at the same time. So if there were questions during the presentation, if you'll get back with me, I would love to hear about that. Some of the polling questions here. One thing is, if I did a really terrible job, please let me know. If there was something that you wanted me to talk more about or you didn't understand, let me know. If there's something you're like, oh, you hit that on the head, let me know on that too. I just want to get better with stuff that you can see. All right. I think our time is up, so have a wonderful day. Give me a call if you have any questions. This is Beth with Insurance Agency Marketing Services, your life insurance sales director. Look forward to talking to you soon.